justifying the down payment based on the value of the car. Now, this tool works for anyone that is selecting comprehensive and collision, regardless of the deductible, but we're going to focus on the value of the car. Now, it doesn't matter if it's a vehicle that's $5,000, $10,000, $20,000, we're still going to focus on the fact that they're actually getting full coverage for that vehicle. We're going to focus on the fact that if something happens, that vehicle is going to be covered. We're going to focus on the fact that that's the reason why they're making a decision on getting a policy for full coverage, simply because they want to protect their vehicle. So we're going to focus on the fact that to obtain those coverages, they need to invest. Everything that has a value, they need to invest. It's not as easy and simple. So you're going to use the concept of you're investing $350 to $400, but guess what? If something happens, they're going to cover the value of the car. You're also going to focus on giving them an idea that if their vehicle was, if the vehicle had a lower value, then obviously the price, not only the monthly payment, but the initial payment will drop. So you're going to use the value of the car, the fact that they're getting coverage for that value, and also you're going to let them know, you're going to compare it to another vehicle that has a lower value to make them understand that it's not us putting the prices together, it's based on their situation, based on the value of the car. And we're also going to let them know, look, you can simply go with lower coverages, but that's not really what you want. That's not really what you're looking for. And matter of fact, a couple bucks, 20, 30, 50, $100, whatever it is that you were hoping not to pay, is going to give you so much value because it's X amount of value of the car. If it's $20,000, I'm going to emphasize, look, this $300 or $400 initial payment, it covers your first month. It gives you coverage. You leave with insurance. As soon as you leave the office, you're covered. Your policy is effective. You take care of the situation. Even though you're investing a little bit more, you're never going to pay this in the future. You walk out of here with the coverages that you want, which is technically what you deserve. You shouldn't settle for anything less, but you have to understand, you have to invest on the policy, because if something happens, the insurance company is going to cover those up to $20,000. That's a lot of money, $20,000. So you're going to demonstrate by using this scenario. So let me give you a quick example as far as the first one, which is the value of the car. So I'm going to tell my client, look, your monthly payment is $175. That sounds great, right? You have the monthly payment available today? Fantastic. Let's continue. Now, let me share something with you, Jonathan. It seems like your monthly payment is the lowest based on 70 different companies. Now, they are requesting an initial payment today, and I'll share with you exactly how that works. What they're requesting today, it's $350 to $400. That covers your first month. It activates your policy. And also, they're requesting that to make sure that as soon as you leave, there's some sort of coverage. There's a 30-day exposure example. Let me review this with you in a couple minutes. But truly, literally, as soon as you walk out of here, not only do you have your liability, which gives you $35,000 worth of coverage, but your vehicle, which is worth $20,000, is also going to be covered. Now, let me share this with you. Now, the way insurance companies evaluate and the way they calculate their rates is based on the risk. So technically, the higher the risk, the more the payments are going to be. The higher the risk, the more they're going to require in the beginning. So today, they are requesting $350 to $400, but let me share this with you. As soon as you leave the office, if anything happens, you're covered for those $20,000. Now, let me just give you a quick scenario. Let's say you leave with insurance today. You go out on the weekend, okay? You park your car, and then as soon as you come back, let's say you go out, you go watch a movie, you park your car. Whenever you come back, your vehicle is gone. The good thing is you purchase a policy that gives you coverage for theft. So in this case, your company, if your vehicle is not found, your company is going to pay up to $20,000. So the risk that they're taking, not only the $35,000 for liability, but $20,000 for your vehicle, simply in the situations of vandalism, theft, fire, or any collision, you are going to be in a position where your company is going to pay up to those $20,000 to get to take care of the value of the car. So therefore, they are taking a risk. So if something happens to that vehicle, they're going to lose $20,000. So therefore, they're not able to just offer you the $175 to get you started. They need a little bit more. 350 to 400 is technically to justify to cover those $20,000. Now, simply by you making a decision today, you do the smartest thing. You're protected. But once again, you have to invest simply because the company is going to take a risk and they don't want to lose too much, especially not within the first 30 days. Once again, if it was just a liability policy, then obviously it would be completely different. But you are leaving with $20,000. That's a lot of money that the insurance company could lose if something was to happen. Scenario number 2. If the value of the car was lower, then of course the rates will be a little bit lower. So you're going to compare that. So let's assume that it's a 2018 Honda Civic, for example. So you're going to tell them, sir, look, even though the insurance company is requesting those $350 to $400, let me share this with you. One of the reasons why is because the value of the car is $20,000. Now, if something was to happen, they're responsible to cover that. So that's a lot of money that they would be losing. So let me give you another example. Let's say you would have purchased maybe a 2010 Honda Civic. The value of a 2010 Honda Civic may be maybe $8,000, for instance. Now, the insurance company is going to take a risk of paying $8,000 instead of the $20,000. So therefore, not only your monthly payment, instead of you paying $175, it probably is going to drop about $100, but your initial payment instead of $350 to $400 is going to drop as well. Now, the reason why it's going to drop because the value of the car is a lot less than the vehicle that you have today. So it's not necessarily that the insurance company or the agency wants to charge you more than the usual, or it's not so much about you paying more than what you should. It's not so much about you paying more than expected. It's about you paying the right amount that's requested to be able to take advantage of the policy that you need. Now, we don't do this, by the way, but if the value was lower, if we were to drop the value from 20,000 to even 15,000, then everything would drop. But then again, it wouldn't make sense because if we drop the value of your car is $20,000, not 15. Why would we insure a vehicle that has a higher value at a lower total of the value? It wouldn't make sense. And either way, we wouldn't be able to do it because the system does it automatically and is based on the Kelley Blue Book. But once again, if you had a different vehicle that had a lower value, that the value of the vehicle was lower, then you would qualify for something lower. But once again, the $350 to $400, it covers your first month. It guarantees coverage as soon as you leave. You have the proper coverages. You're going to take care of the finance company. They're not going to bother you. And you leave with insurance. You leave with the right, proper coverage. So in case something happens, you have nothing to worry about. So those are two scenarios that you could use when we're calculating the value of the car. Now, it's very important for the client to understand that due to the value of the car, the insurance company is going to take a larger risk and their losses could be a lot higher. So therefore, they require a little bit more. Now, if you don't really elaborate on that, then they're not going to understand that. Third example, you're going to tell them, look, you wouldn't want the insurance company to send you a notification letting you know that they're only going to cover 50, 60% of the car. So you're going to create a scenario and you're going to tell them, look, maybe another agency could lower the value of the car, similar to what I was sharing on the previous example. They could lower the value of the car. We don't do it. We don't work like that. We do things the right way. But if they were to do that without telling you, and you were to receive a notification from the insurance company telling you, look, sir, we thank you for your business. We're going to take care of the accident, but due to the plan that was offered or was selected, you only qualify for 60% of coverage. So we're only going to cover 60% of the car. That wouldn't make sense, right? They're going to say, no, absolutely not. So therefore, let's invest on the option that you need to take, on the right option to give you the right coverage. So, sir, I completely understand that the $250 to $300 may seem a little bit more than what you expected. $350 to $400, I understand that's a little bit more than what you wanted to pay. But let me share something with you. Now, this may be common, not with us, but it's common within other agencies, especially agencies that don't follow the right way of doing business. Now, one of the things that they could do is lower the value of the car. So let's say the value of your car is $20,000, and you could show them on the FSC. Let me show you on the FSC. I could type in the value, whatever value I want to request for the rate So let's say instead of 20, we put $15,000 for instance, right? Show them where it gives you the option of adding the value on the FSE. Tell them, let me just share this with you. Let me just show you how it works. Now, simply by reducing the value of the car, the rates are going to lower. Your monthly payment is going to lower. Your initial payment is going to be a little bit less. But let me tell you the situation. Now, in case of an accident, the insurance company is not going to cover the full value of the car based on the Kelley Blue Book. They may go based on whatever they actually inputted. So just imagine you have an accident. It's a total loss. You're expecting the insurance company to cover those $20,000 that the Kelley Blue Book is showing that it's worth, and you receive a notification letting you know that unfortunately, due to the plan, you're only going to get $13,000. First of all, what would he say? They're going to say, no, that's insane. I will get upset. They're going to start complaining. I'll get a lawyer, whatever it is. Tell them I understand that, but you signed it. But either way, it wouldn't be a good feeling, right? And they're going to say, no, absolutely not. That would be the worst feeling, and I would feel so devastated if I was to hear that story again, which I've heard it a couple of times. It's insane. I get so upset when I hear these stories because everybody should work the right way. Everybody should help clients the right way. Now, let me help you by doing things right. Now, once again, what I do guarantee you is that I'm doing everything the right way. I'm giving you the policy that you deserve. I'm giving you the policy that you're requesting. We're doing everything the way we should. So in case something happens, you have nothing to worry about. Those $350 to $400 may seem a little bit more, but that's the biggest investment. That's the most important investment that you're going to make. Once again, because we're doing things right, we're setting you up with the lowest option based on 70 different companies. The $350 to $400, you're never going to pay that again. It's a one-time payment. You're investing on a one-time payment, and you're going to keep the lowest option. And we could also help you with a payment plan. So use these 3 tools when you're justifying the down payment, especially if you have full coverage. Number 1, the value of the car. Definitely due to the value of the car, they're always going to require a little bit more. Number 2, give them a scenario that lowering the coverage, lowering the value of the car, the rate, monthly payment, and the initial payment, they decrease. So they may qualify for something lower, but we're not going to do that. Number 2 was comparing it with a different vehicle. So if they would have purchased another vehicle with a lower amount, they would qualify for something lower. But unfortunately, they have a newer vehicle and they need to get coverage for that car. Number 3, you introduce a scenario that if the value of the car was to be lowered, if we decrease the value, if we input a lower amount, then everything drops. But we wouldn't do it. We don't do it. We wouldn't advise them to do it. They would be upset if they're in that situation. So once again, use all these 3 tools when you're justifying the down payment, especially if the vehicle has full coverage. And if it's multiple vehicles, even better. Increase the quantity of the value per car, and that puts them in a different perspective because now it's not $20,000, it may be $60,000, or maybe $100,000 if they have 3 cars that are worth $30,000, $40,000. Use this tool, it works all the time.